Joining us this afternoon is Ashok Kumar, Managing Director at LKW Investment Advisors. Ashok, as always, thanks very much for joining us on NDTV Profit. And I kicked off our introduction today by underlining the word safe in the context of the cuts that we've seen recently in equities. Now, as I put that proposition on the table, it leads us directly to, tax saving funds and ELSS, because this is also the start of a new tax season. So should we kick off our conversation for absolute starters, those who have no idea what that acronym ELSS even stands for? Give them a short introduction or a summary about ELSS.
Yeah, good afternoon, Manvi. As far as ELSS goes, it's an equity-linked savings scheme. It's one of the options under which you get a tax break under ATC, and it's an important thing because finally a rupee saved is a rupee earned, and especially in this kind of turmoil, I think every rupee counts. So what we have with an ELSS, traditionally I think ATC investments have always moved or gravitated towards PPF almost by default. Now, that's a fine product, that's a government guaranteed product, it gives you a reasonable return for a debt product, and it's tax-free. There weren't too many options, but now I think as investors get more aware, those with a slightly higher risk profile have started looking at ELSS, which is the tax saving scheme that is offered by mutual funds. A couple of points that go in its favor. Very clearly, the returns look a lot better than that of the debt products that are available. On a comparable basis, I think only PPF compares not in terms of returns, but in terms of what the government calls EEE, which is exempt, exempt, exempt. At three stages, one is at the time of investment, you get a tax break. The interest or income generated in the case of PPF or in the case of ELSS, in which case it is gains, would be tax-free, and at the time of withdrawal too, it's tax-free. So these are unique products, the PPF stroke, the Employee Provident Fund, and the ELSS.
I'm just going to jump in there, Ashok. Sorry, I'm just going to jump in there again, assuming that there are some watching who are wondering what this is. This is the introductory guide up front. The issue sometimes is that Section 80C, in a sense, can get exhausted by so many things: repayment of your housing loan, premium on insurance policy. In a sense, there's a competition for claiming that Section 80C exemption, isn't there? And the other factor, of course, is that the underlying asset is equity. So there's no guaranteed return as far as ELSS is concerned.
No, well, very clearly that's right. That's what I said. I said somebody with the additional risk appetite, and what you say is right. Quite often it's the housing loan, or it could be interest, and there are multiple things that could take away ATC. Now, when we talk about ATC per se, traditionally, I think somebody who's not got insurance normally goes in for the PPF to fill in the amounts. Historically, that was the choice. But what I'm saying is somebody who's young, somebody is looking at a limited kind of coverage. Quite often ELSS could be a viable choice because the returns are a lot better. One very big advantage that I can see there is that you invest only for the first 3 years. Assuming you're investing the full amount, of course, the same money can be rotated, which cannot be done with any other ATC product.
Fair enough. Now let's talk about specific options out there, and I'm going to flag off the fact that you picked these three based on them being low-risk options. First up is Axis Long-Term Equity Fund.
Yeah, I mean, the choice of these three, and I must add the caveat here that these were the returns at the end of the last quarter. I think they would have taken a bit of a beating in the market meltdown that we're seeing. But, having said that, I think these are three funds. If you look at parameters, if you look at risk-reward ratios and other things, you would find that these are, somewhat time-tested products. And they're also relatively lower risk, which helps them to sort of tide through the difficult times. An advantage with the ELSS product per se, before going on to these funds, is that the fund manager has an advantage of a 3-year lock-in. So, there's no massive unforeseen redemption pressure. Okay. Which could affect an open fund. So to that extent, yes, in each of these funds, you would see that The portfolio building is far more conservative than you would find with a pure equity fund. Even among ELSS funds, there are higher risk funds and lower risk funds. These three, which one being the Axis, the long-term fund, the Tata India Savings Fund, and the third one being the Franklin India Tax Shield Fund. These are three funds that have played it safe and yet managed to give good returns. So first-time ELSS investors, although willing to take some risk, not wanting to go the whole hog, could look at these three funds.
Okay. Just a quick disclosure from you, Ashok, on whether you have any exposure in these funds.
As far as these funds go, as Franklin India Tax Shield Fund is one that so we have and our clients also have. Historically, we've been investing in this fund. But, again, that does not, take away from the fact that the other funds are also good. In fact, most of the ELSS funds, interestingly, have done fairly well. A very interesting facet of ELSS fund is that although it's a 3-year fund, the 5-year returns have also been reasonably good. So somebody who's chosen to stay on has not, has been adequately rewarded.
I think that's a very important point that you make as well. The fact that the 5-year returns have been pretty good as well for the three that at least we put out on the screen based on the research done by LKW Investment Advisors. Now on to the new fund offerings, and on the radar is the HDFC Retirement Savings Fund. What's the USP of this fund?
Yeah, well, what the USP is that one, it is also eligible for ETC, so it's timely at this point in time. It's also a pension fund, so that there are two options there. Now, when you look at this fund offering, it's somewhat unique to the extent that there are three offerings. One is you go with pure equity. The second is a hybrid option where you go predominantly with equity and partially with debt. And the third one where you're predominantly going with debt. Now, this is unique to the extent that the second and the third choice are hybrid funds, really speaking. So that makes it a somewhat unique choice as far as ATC goes. But there are spoilers too over here. Now, the spoilers being, for a relatively young investor who chooses to get in here and, if at all someone's thinking early about retirement, the problem is, number one, there's a 5-year lock-in in this, unlike a typical ELSS fund, which has a 3-year lock-in. Two, even after the 5-year lock-in, if you choose to get out of this before you turn 60 years of age, you would pay a 1% exit load, which I think is a trifle harsh there. And there is also the fact that, in case this fund turns out to be a non-performer, you do not have the flexibility to exit this fund except at a cost. So I would tend to wait and watch a bit before taking a bite of this fund, if at all I do, because I think the positives and negatives sort of blank out each other.
Okay, and you had compiled a list of peers for this. So we've got the HDFC Retirement Savings Fund, and for those who are trying to evaluate and decide what they want to do, and of course, since this is called very specifically a HDFC Retirement Savings Fund, there is a certain age profile that will show interest in this. So just run us through the peer options that exist.
Right. As far as a peer option goes, there are two funds that are available from, one is the UTI Retirement Benefit Plan and the other is the Franklin India Pension Plan. Now, these are both purely debt products. So they're not strictly comparable. I think a relatively comparable fund was the Reliance Retirement Fund that hit the market around a year ago. Again, the time frame has been too short to draw any serious conclusion there. I would still wait and watch. Perhaps, if at all someone has to get into this space, watch for a year and a half more before choosing between these two.
Okay, and one other clarification, Ashok. When we were talking about the HDFC Retirement Savings Fund, and we put out there that, if you're going for the equity plan, the equity component or allocation is 80 to 100%, and we further went on to talk about the hybrid, where the equity component is 60 to 80%. This is up to the discretion of the investor to decide exactly what percentage?
No, the percentage is not decided by the investor. You need to make a choice of option 1, 2, and 3. 1 being the, more or less the pure equity option. The second being similar to a balanced fund where you have about 60 to 80% in equity. And the third being a quasi-debt fund. So clearly you're going to make the option at the outset. The percentages would be determined by the fund manager based on market conditions. What the point that emerges, Manvi, just like a fund house that made an issue a month ago and we spoke about it, is that you can alternatively replicate this with funds that are already there in the market. You may not get the ATC benefit. I'm assuming that you don't need it, which would be the case with most people. I think why not simply go for a regular fund, regular balanced fund, a regular equity fund, or a regular debt fund, because there wouldn't be a problem with exit. I mean, assuming the fund is non-performing, you could always switch it. Here, one of the problems is that you could switch only at a cost.
Fair enough. I think the next step now is, of course, the budget. And when we were talking about the beginning of a new sort of tax saving season, people also have an eye on what the budget may or may not deliver. So let's just run through some of the popular expectations. And I say popular because there's a build-up that peaks just before the budget. And then, of course, we get to know on budget day exactly what the finance minister has done. But in the build-up, you've used the word or the phrase red herrings in the context of a bunch of things. Let's talk about those specific red herrings, Ashok, that you're flagging off.
Right. Yeah, as far as the red herrings go, clearly, I mean, expectations run high whenever there's a budget, but that's par for the course, and the final decision maker, of course, being the finance minister. So let's not go there. What could be the red herrings are areas that could really spook the markets. There is a buzz about the STT, which is the Securities Transaction Tax, which I think is a very efficient tax at source. It's akin to TDS, where the government is generating a fair amount of revenue, getting replaced with the old regime of capital gains taxation for equity. Now, that would hurt the market, and that would hurt it big time, given that equity penetration in India is dismally low compared, even with comparable nations, emerging markets. I think that would be a fatal blow to the market if that is done. And I also think it'll leave a gaping hole in the government's pocket, because given the kind of market conditions, I don't think there are too many gains to be taken, or rather tax to be collected on too many gains. But STT is a very efficient tax as far as the government is concerned. Replacing that could be a serious problem.
Okay, we'll leave it on that note. Ashok, thank you very much for joining us this afternoon. As always, pleasure having you here on NDTV Profit. And today, of course, as a new tax season kicks off, we've had a chance to touch upon some interesting options for investors with the adequate warnings that come with them. Once again, thank you.